Hello viewers, once again welcoming to you all to this educational channel Accounting Equations Academy. Today I am here with a chapter partnership in which a problem being based on admissions of a new partner. So while solving these problems, the following points are to be kept in mind: the new profit sharing ratio, sacrifice ratio, treatment of premium for goodwill, revaluation of account, capital account of all partners including new partner, balance sheets incorporating the increases and decreases in the value of assets and liabilities along with the capital balance of partners. So these are the points that we have to keep in mind while solving the problems, and all these items are normally getting effect in the problem. So have a look a problem on the screen. So all of you watch the problem step by step. I am going to explain the first I will explain the questions, then solutions. All of you watch this till the end, and don't forget to like, subscribe the channels and sharing with your friends. Okay, so have a question. So here the question is: A and B are partners sharing profits and losses in the ratio 2:3 on 31st March 2018. Their balance sheet was as under. A and B balance sheet is on 31st March. Now on the liability side, so capitals of the A and B are all partners. Capital A 48,000, B 84,000. So liability side, creditors 64,000, bills payable 32,000, profit and loss account, reserve balance, this is the free reserve, and this amount will be transferred to partners capital account, and this is the grand total of liability side 2,42,000. Thereafter on asset side, cash 18,000, bills receivable 24,000, furniture 28,000, the stock balance 48,000, debtors. So all these are the assets, and goodwill is here. Goodwill is to be written off to partners capital account, that is, it should be debited to partners capital account, and this goodwill already exists in the books of account. So it implies that goodwill is already in the balance sheet, and this is the 20,000 rupees. Asset side 2,42,000, liability side also 2,42,000. Now let's see what are the adjustments given in the question. Let us see the question for adjustment. They admit C into partnership on the following terms: furniture and machinery are to be depreciated by 15%. Depreciated, decrease in the value of assets. The stock value is revalued 48,000. When it is revalued, then we cannot say whether it is increased and decreased revalued unless it is compared with the existing figure. So if a stock value is 48,000 and here 44,000, that means the value of the stock is increased by 4,000. This is so 44,000, it is 48,000. Outstanding rent amounted to rupees 1,800. This liability balance is not given in the balance sheet, so it is emerging as a new liability. And prepaid salary is also not in this question. Here in this balance sheet, outstanding rent amounted to rupees 1,800. So it is a liability, so it is not appearing. So new liability is emerging, new liability, so it is increase of liability. So liability amount is increased by 1,800 in the name of outstanding rent. Assets value is increased by rupees 800 in the name of prepaid salary. Now here C is the new partner, will bring rupees 30,000 towards capital and rupees 6,000 as premium for goodwill for 1/6 share of profit. Capital of A and B are to be adjusted in the new profit sharing ratio. The capital C as the case. Incoming partner C has brought the capital rupees 30,000, and the existing partners A and B, they will adjust their capital balance as per new profit sharing ratio. So it is given here that adjusted in the new profit sharing ratio. That means you need to calculate as per the new profit sharing ratio. It means the new profit sharing ratio is not given. This is the ratio which is given. It is called old ratio. And now I will show you the calculations of new profit sharing ratio and sacrifice ratio. So sacrifice ratio is required for premium for goodwill adjustment. That is the premium amount given. It will be credited to existing partners capital account in their sacrifice ratio. So the ratio sacrificed in favor of C by A. So ratio sacrifice in favor of C by B, and for sacrificing this they are getting premium for goodwill. Alright, so adjustment, and the next one is here given. Adjustment of capital will be made in cash. So these points I will explain you along with the solution. So prepare revaluation account, partners capital account, and balance sheet. Okay, now solution on the screen. So now you all of you bring a smile on the face because you are learning solution. Here the revaluation account, the first accounts we are preparing. Debit side, decrease of assets, increase of liability, and credit side, increase of assets and decrease of liabilities will be recorded. So furniture value depreciated, it is a decrease in the value of furniture by 4,200. Similarly, machinery value is decreased by rupees 5,100. Depreciation given in the adjustment. Machinery value is given 34,000 and 15% of 34,000 it comes 5,100. Outstanding rent, as I explained you already, that it is the increase of liability and it is to be debited. On debit side, these three items. Credit side, the stock value is increased by 4,000, and prepaid salary is the current asset, it is increased by 800 rupees, since the prepaid salary also not available in the balance sheet. So it is given in the adjustment, and it means that the amount of assets increased by rupees 800. Balancing of revaluation account. Let's see which side is having greater value, total value greater, debit side or credit side. So it seems debit side is having greater value in aggregate in total than credit side. So here 4,200 plus 5,100 plus 1,800, 11,100, and in credit side it's only 4,800. So 11,800 minus 4,000 minus 800, so balance is 6,300. Since debit side is greater than credit side and it represents loss, and that loss shall be transferred to loss on revaluation. And in the old profit sharing ratio, A and B, new partners is not entitled to share profit or loss on revaluation. Only old partner, that is A and B, they will share the loss on revaluation in their old profit sharing ratio, and it is given in the question 2:3. 2 by 5 of 6,300, 25, 20, 3 by 5, 6,300, 3,780. On calculations you will get this value, and this is the loss, and this loss shall be transferred to debit side of partners capital account. Profit is credit side of partners capital account, but loss debit side. Partners capital account, debit side, credit side. Partners capital account is started with opening balance of capital, and this opening balance of capital which is given in the existing balance sheet question. So A is 48,000 and B 84,000. C is a new partner, so he has no opening capital balance. In fact, he will bring his share of capital, and he has brought in the next entry. It is recorded by cash account rupees 30,000. This is 30,000. And at the same time, when the new incoming partner admits to partnership form, it is generally he has to bring premium for goodwill, and it is given in the question 6,000 premium for goodwill, and that is it is shared by A and B, that is A and B, and this amount will be credited to partners capital account in their sacrifice ratio, and sacrifice ratio is 2:3. So 6,000 into 2 by 5 and 6,000 into 3 by 5, then this amount 2,400, 3,600, the premium for goodwill which is brought by C. And profit and loss account, this profit and loss account balance is given in the question. It is a free reserve, and this free reserve amount all partners entitled in their all profit sharing ratio. So profit and loss account balance, which is given in the questions on the liability side of the balance sheet question, and it is showing 14,000 profit and loss account balance, and this profit and loss account balance term free reserve, and partner A and partner B are only entitled to credit this amount to their capital account, and in the ratio of 2:3 old ratio. So 2 by 5 of 14,000, 5,600, and 3 by 5 of 14,000, 8,400. In this way, the free reserve, that is profit and loss account amount, is distributed and credited to all partners capital account. Now on the debit side, goodwill account, which is appearing in the old balance sheet, rupees 20,000, that is to be debited to all partners capital account in all profit sharing ratio, that is 2:3, and 2 by 5 of 20,000, 8,000, and 3 by 5 of 20,000, 12,000 debited to partners capital account A and B. Similarly, loss on revaluation account shall be transferred to partners capital account on debit side. Loss debit side, profit credit side. So this is calculated in the revaluation account. That balance is to be transferred 2,520 and 3,780. After transferring all the transactions pertaining to partners capital account, we have to balance the partners capital account, and for this, as this is the point, that is the by to balance sheeting, the point you have to focus in this partners capital account, and this is the 60,000 and this is 90,000 rupees and this is the 30,000. So to understand this balance to being obtained, so I will take to you all the working notes where you have to calculate the new profit sharing ratio and share of capital of each partner as per the new profit sharing ratio. Okay, before going to working note for calculation of new profit sharing capital, so all of you smile and let's go to working note. Now here is the calculation of new profit sharing ratio. I will show you. This is the, let the total share be 1 and remaining shares 1 minus 1 by 6. So obviously you have understood that 1 by 6 is the new ratio given to new incoming partner C, and after giving him his share, the remaining shares will be distributed, will be a remaining share amount will be shared by old partners in their old profit sharing ratio. So 1 minus 1 by 6, it is coming 5 by 6, the balance. This is the 5 by 6 balance, and this 5 by 6 balance shall be shared by A in the old profit sharing ratio. So A's old profit sharing ratio is 2 by 5 into 5 by 6, then it is 10 by 30. So 2 5 are 10 and 5 6 are 30. And similarly, in the same manner, B's share is also calculated. 3 by 5 into 5 by 6, 15 by 30, and C's new share, it is just is the balance is equal, that is 5 by 5 by 6 into 5 by 5, multiplying to get the value of 30, and 5 by 5, if you multiply it by 5 by 5 to 1 by 6, then the value 5 by 30. So in this way, the new profit sharing ratio of A, B and C is 10 is to 15 is to 5, and it can be reduced to, all are divisible by 5, so 5 2s are 5 3s are and 5 1s are. So you can take this ratio or you can take this ratio. Adjustment of capital as it is given in the question. So adjustment number 5, that the capital of A and B are to be adjusted in the new profit sharing ratio, taking the capital of C as the base. So it is given in the question that the C's share of capital rupees 30,000. Then the total capital of the new firm on the basis of C's capital will be calculated in the following manner. That is rupees 30,000 share of capital of C, and his share of profit will reciprocal of share of profit, that is 1 by 6 becomes 6 by 1. The reciprocal of share of profit will be taken. This 1,80,000 is the aggregate capital of A, B and C. Now this is the on the basis of C's capital, share of capital, so C's share of capital is already adjusted. Now A and B, they will adjust their capital balance in the new profit sharing ratio. Okay, so that is 2 is to 3 is to 1. So A will maintain his capital 2 by 6 of rupees 1,80,000. B will maintain 3 by 6, this is 3 by 6 here, 2 by 6, 3 by 6 and 1 by 6. Now A will maintain his capital in this ratio. So 2 by 6 of 1,80,000. Here it is given. See this, A share of capital 2 by 6 of rupees 1,80,000. So balance is 60,000. So A will maintain his capital balance rupees 60,000 in new partnership form. Similarly, B share of capital 3 by 6 of 1,80,000, so 90,000. Now B will maintain his capital balance in partnership form rupees 90,000. And if you calculate C's share of capital, so you will get 30,000, because base is C's share of capital, and you will get 30,000. Okay, so in this way, now just I told you that in the balance CD of capital account, the amount which is written 60,000, 90,000, 30,000 is obtained from with the help of this calculations. Now you have understood this value calculation, and now they have these partners A, B and C. This amount shall be appeared under to balance CD. That is, this is the closing balance of this capital account, and thereafter the balancing of account shall. If the debit side is having greater, then when we total it 8,000, 2,520 plus 60,000, the total balance is 70,520. Credit side, it's showing 48,000 plus 2,400 plus 5,600. See, I will show you the cap. 48,000 plus 2,400 plus 5,600. Now credit side is less amount than the debit side. Debit side amount, this one is total amount. This is the total balance of debit balance side, debit column of A, but credit column of B is having 56,000. So that means his balance is not sufficient to make the equal to 60,000, and he has to bring amount 56,000 minus 70,520. So 14,520, the additional amount A has to bring into business, and it is represented by cash account. This is the cash account and balancing figure. In the same manner, B's account is balanced, and on debit side B is having 1,05,780, but credit side is not having that much amount. The amount is less, so then the difference, that is 1,05,780 minus 84,000 minus 3,600 minus 8,400, then the balance you will get 9,780. So this is the shortfall amount or deficit amount that B has to bring into business. If debit side is greater amount than the credit side, then it is a shortfall. They will bring. If credit side is greater amount than debit side, then this is the surplus. They will take the money from business. Then here we have to write to cash account. Okay, so this is the capital account, especially when it is adjusted on the basis of new profit sharing ratio. Now balance sheet, new partnership form, new balance sheet. Balance sheet of A, B and C as at 31st March 2018. So liability. So that capital account balance is to be transferred here. So A's capital balance CD 60,000, B's capital balance CD 90,000 and C's capital balance CD 30,000. That is the total closing balance of capital of the partners, and altogether 1,80,000 is the capital balance. The balance of creditors appearing in the questions will be appear at same value since it has no adjustment. Similarly, bills payable will appear at its old value at same value since it has no adjustment. So in the old balance sheet question or in the question, creditors balance is 64,000, and in the new balance sheet it will also be remain same, and bills payable also remain same. So these two items have not been affected. An outstanding rate, it is a new liability coming into existence. Furniture value is depreciated 28,000, depreciated by 4,200. The balance is 23,800. Machinery value is also depreciated by 5,100, which represents 15%. After deducting the amount of depreciation from 34,000, the balance is 28,900. And investment remain unaffected. So the same value as appearing in the old balance sheet. And stock value is increased by 4,000. So total in old balance sheet 44,000. Increased value 4,000. It is 48,000. Then bills receivable remain unchanged. Debtors balance will also be remain unchanged, since these items have not been affected and no adjustment, and it's these items values are neither increased nor decreased. Prepaid salary increasing our new assets, that is the 800 rupees, and cash balance. So a separate working note is prepared for cash balance. I will show you that how it is. How did you this value is obtained? 78,300. Total amount of the balance sheet on liability side 2,77,800, and on asset side also 2,77,800. Now have a quick look on cash balance working, how it is prepared. If there are number of transactions relating to cash, so it is better to prepare a cash account, and finally the balance shall be transferred. This 78,300 balance which is obtained, and it is transferred to balance sheet. If cash transaction in business is having few, then it is better to prepare a cash account under working note. And this is the balance BD, opening balance 18,000, cash balance given in the question, and this is the capital amount brought by new incoming partner C, and premium amount brought by incoming partner C, and that is the cash is coming double effect on capital side and in cash account. And this is the amount, deficit amount, which is brought by C to make his capital balance equal to 60,000, and B's capital balance, which he has brought cash rupees 9,708. When we total it, so this is the 78,300, and this balance CD, and credit side no items, no cash going. Okay, so credit side simply the closing balance, balancing of account, and total balance. Now this balance is going to is appearing in the balance sheet. So all the viewers, please watch it, like, subscribe and share with friends. Thank you very much. Jai Hind.